Assalamu alaikum. My name is Mal Trading Wala, and today we have our AI session. And today our topic uh, is overconfidence in trading decisions. Decisions. Hi ChatGPT, how are you and how are you doing? And today our topic is what is overconfidence in trading decisions.
Overconfidence in trading decisions is basically when a trader believes too strongly in their own abilities, knowledge, or predictions. They might think they're better at assessing risks or spotting trends than they really are. As a result, they take bigger risks, ignore potential red flags, and often end up with bigger losses because they underestimate uncertainties. So it's kind of a blind spot, thinking you know more than you actually do.
So what is the overconfidence bits in trading?
Yeah, that's a great follow up. The overconfidence bias in trading is essentially this psychological trap where traders overestimate their accuracy. For example, they might trade more frequently, ignore stop losses, or hold on to losing positions too long because they think they can outguess the market. It's a super common pitfall, especially in volatile markets, and it can lead to big losses if left unchecked.
What do traders becomes overconfident after
Yeah, it
wins?
often Exactly. A few early successes can really fuel that overconfidence. After making some profitable trades, traders might think, I have this all figured out. And then they take on bigger risks or overlook their strategies. It's really that success trap. Once you feel unbeatable, that's when reality hits. So it's crucial to stay grounded, keep a disciplined plan, and always respect the risk.
So how does overconfidence um,
So, overconfidence tends to skew a trader's risk management. They might underestimate potential losses or assume their past success will continue. This can lead them to overtrade, allocate too much capital to a single position, or ignore signs like market volatility or economic shifts. Essentially, it clouds their judgment, making them less likely to pull back or diversify, which increases their chances of big losses when things turn.
so how does overconfidence decode um, risk
Yeah,
pressure?
I see what you mean. So, overconfidence decouples risk because the trader stops giving risks their due weight. They don't objectively analyze how much they could lose or the probability of a downside. Instead, they assume outcomes will always go in their favor. So, they might skip diversification, ignore stop losses, or just size up trades way too much. In short, they detach from realistic risk assessment, and that's when trouble starts.
So what is the difference between overconfidence and overconfidence?
Great question. So, overconfidence is that general bias, thinking you know more or are more skilled than you actually are. Overtrading, on the other hand, is a behavior that often stems from that overconfidence. When traders believe they're invincible, they start placing more frequent trades, chasing quick profits, or reacting impulsively. So, in short, overconfidence is the mindset, and overtrading is the action that follows from it.
So why is certain danger in financial market?
Yeah, exactly. And that's where it gets really risky. In financial markets, even a small misjudgment can have huge consequences, especially because these markets are so complex and fast moving. Overconfidence can lead to excessive risk taking, underestimating volatility, and not preparing for worst case scenarios. That's why disciplined risk management and staying humble, recognizing your limits, are so crucial to long term success.
So how does it at- attachment influence trading decisions?
That's a really interesting one. So, attachment can creep in when a trader emotionally bonds with certain stocks, assets, or even past winners. They might keep holding onto a losing position because they feel personally attached, like it's part of their identity, rather than objectively evaluating it. That emotional tie distorts logic, leading them to make less rational decisions. So, they end up staying in bad trade way too long, which can hurt them in the long run.
Um, how can overconfidence exist even with the profit simple strategy.
Yeah, absolutely. So even a really solid strategy can get derailed by attachment. If you start prioritizing an emotional connection over your rules, like holding onto a stock just because it used to perform well, you break that risk management discipline. So the trick is to stay committed to your strategy, even when it conflicts with that gut feeling or attachment. And that's what helps you stay consistent and profitable long term.
So, how does simple size illusion create false confidence?
Great point. The sample size illusion happens when traders base big conclusions on too few examples, like thinking they have a winning strategy just because of a sure winning streak. This illusion tricks them into overconfidence, assuming the positive results are a sure pattern when really it's just luck or noise. Over time, that belief makes them take bigger bets or deviate from their plan, which can end in big losses when reality catches up.
Okay, so why do beginners overestimate market understanding?
Yeah, it's super common. Beginners often have a few early wins or just a basic framework, and they mistake that for real mastery. They might consume a few blogs or watch a couple of videos, and suddenly they think they understand complex market dynamics. The reality is, it takes a ton of experience to really grasp risk, timing, and how different factors into play. So that overestimation just sets them up for bigger surprises.
Okay, so how does probability think counter overconfidence?
Great question. Probability thinking is all about grounding your decisions in actual likelihoods and outcomes rather than just your intuition. So, when you consciously assess probabilities, like thinking in terms of risk reward ratios or the statistical chance of an event, you stay anchored in reality. It stops you from just extrapolating from a small sample or letting success go to your head. In that way, you stay balanced, more realistic, and less prone to overconfidence traps.
Okay, so why do overconfidence trade ignore stop losing or dying?
Yeah, that's a really big risk. Overconfident traders tend to believe they can just wait it out, thinking the market will turn in their favor, or that they're too sharp to need a stop loss. But that's exactly when risk explodes because they avoid the boundaries that would protect them. Without that safety net, small losses can spiral and they end up in much worse situations.
So why does position size increase due to confidence bits?
Yeah, so when confidence bias kicks in, traders often feel like they can handle more risk because they've proven themselves. So they start increasing their position size, betting more per trade because they think they'll keep winning. That amplifies their exposure, so when a small downturn hits, it really magnifies the losses. So that false sense of mastery leads them to take on way more risk than they should.
So why do trader overtrade after the consume wins?
Exactly. The key is to consciously manage that risk. So even if you feel really confident, you stick to predetermined position sizes, set limits on each trade, and never let a win or a losing streak drive your sizing. That discipline keeps you from getting caught in the overconfidence spiral.
So does guts feel replace analyze under overconfidence?
Yeah, it really can. Gut feelings are often just quick, intuitive reactions, but they don't always reflect the actual data or probabilities. Overconfidence can arise when traders trust that gut over objective analysis. So the danger is that you start skipping deeper research or risk checks because you feel like you know what's going to happen, when really it's just an illusion. So it's super important to balance intuition with solid rational analysis.
Okay, so why do overconfident trading predicts market certainly?
Yeah. So overconfident traders tend to believe they have a special insight or a foolproof method, but markets are just too complex and random for that. Even experts can't predict them with certainty because so many variables economic, geopolitical, human behavior play a role. So that misplaced confidence blinds them to randomness and uncertainty, which leads them to overtrade or misjudge risks.
So how does doubling down or losing trade reflect overconfidence?
Yeah, exactly. So when a trader's overconfident, they often refuse to cut their losses because they don't want to admit they were wrong. They think if I just hold on, it'll turn around, even when all the signs say otherwise. That refusal to accept a loss keeps them in a losing position longer, increasing the overall damage. So it's really that emotional resistance to loss, fueled by that inflated sense of certainty.
So why do traders hard does doubling
Uh,
down? Why do traders refuse to exist losing positions?
Right. So traders refuse to exit losing positions because of this psychological commitment to being right. It's like a sunk cost fallacy. They don't want to accept they were wrong, so they double down, hoping for a rebound. Plus, sometimes there's a fear of missing out. If they close the position, they might miss a sudden turnaround. But in reality, that reluctance just locks in bigger losses and delays the inevitable. So it's all about ego and emotion, not rational risk management.
So you have the guts to keep your ego.
Exactly. It
How
takes
does
a lot of
revenge
courage.
trading content to ego damage?
Yeah, so revenge trading is really dangerous because it's when a trader tries to immediately recoup a loss by taking impulsive, often bigger risks. And that's driven by a bruised ego. They feel humiliated by loss and want to prove themselves right again. In that emotional state, they stop following their plan, they chase losses, and they often amplify the damage. So that ego driven behavior just leads into a spiral of even bigger mistakes.
So why do traders blame manipulating instead of mistakes?
Yeah, that's a big one. A lot of traders, especially when they're overconfident, don't want to admit their own errors. So instead of saying, I made a bad decision, they look for outside factors like blaming a sudden market shift or bad luck. This externalization keeps them from learning from their mistakes and it lets them avoid adjusting their process. So the blame game just traps them in that same cycle.
So how does this ignorant risk reward um, risk signal confidence?
Yeah, so when traders ignore the risk reward signals, it's often because their confidence is so high they think they can just keep winning no matter the odds. Instead of assessing whether the potential upside justifies the risk, they just chase the next move. Over time, this makes them overexpose themselves to losses because they skip those critical evaluations, like thinking, is this trade really worth it? So that overconfidence blinds them to the real risk they're taking.
So why does the during buffer effect applying to trade?
Ah, that's a great one. The duration effect says that people tend to overvalue short term emotions compared to long term outcomes. In trading, that means a trader might focus on the excitement of a quick win or the pain of a recent loss, rather than seeing the bigger picture. So their short term emotional slings, like fear or greed, can drive them to make impulsive decisions, ignoring that long term risk reward balance.
So why does particular knowledge create false mystery?
Yeah, that's a tricky one. When traders learn a few concepts or hear a couple of market rules, it gives them a sense of control, like they understand what's happening. But that partial knowledge is misleading because markets are so complex. They start to believe they have a bigger edge than they do, so they take bigger risks or ignore signals that don't fit their new framework. That's when false mastery kicks in. They think they know more than they actually do.
So so how does comforting builds disc supports market signals?
Yeah, exactly. Comforting beliefs are those simple, familiar narratives like thinking, I have a special system that always works. So they give a false sense of safety. Traders cling to these comforting stories because they reduce uncertainty, even though the markets don't actually care about those stories. So it keeps them from adapting or seeing the bigger, more random picture.
So when do traders see only supporting market signals?
Yeah, that's a real danger. When traders are overconfident, they tend to focus only on signals that confirm what they already believe. So if a trade aligns with their bias, they latch onto it, ignoring contradictory data. That selective attention keeps them from seeing red flags or balancing risks. So they end up in a bubble, just reinforcing their own narrative, and that's when the market shocks them.
So how does illusion of comfort distort market pressure?
Exactly. So when traders cling to comforting illusions, they overemphasize patterns that aren't really there, which can create artificial demand or supply. If a whole group of traders believe something, they push prices up or down artificially, even though the fundamentals don't support it. So this illusion warps actual supply and demand, causing mispricings that can snap back when reality catches up.
So why does memory of winning overshadow memory of losing?
Yeah, that's a big psychological bias. Our brains naturally give more weight to recent or vivid wins because they feel rewarding. So we remember that high and forget the sting of a loss. That skews decision making, making traders think I'm on a roll, even if the data says otherwise. So this leads them to take bigger risks, hoping for another win, but they end up ignoring those subtle but crucial losses that should be guiding them.
And they think they are master of trading.
Exactly. And that's when the real danger kicks in because they start thinking every decision is a sure thing. They stop questioning their assumptions, ignore risk controls, and get caught in that trap of overconfidence. So the more they believe they're a master, the more reckless they can become. And that's when the big losses pile up.
So how to cover the big losses in which they can do?
Yeah, the key is to step back and get really disciplined. First, they should have a solid risk management plan in place, like setting fixed position sizes and stop losses before each trade. They also need to accept losses as part of the game. No revenge trading, no doubling down. And if needed, they can step away, recalibrate their strategy, and get a fresh perspective. So that way they break the cycle and avoid those catastrophic blow ups.
If they want money, they should be more disciplined and strategy making, not for revenge, not for something they do not do. Yes.
Exactly. Discipline is really the foundation. They need to stick to their strategy, not let emotions drive them, and stay focused on long term goals. By being consistent and analyzing their trades objectively, they'll keep their risk in check and give themselves the best chance to succeed over time.
So how does ego defense perverts learning from their mistakes?
Yeah, that's a big problem. Overconfidence makes traders think they already know what's best, so they don't fully analyze what went wrong. Instead of adjusting their approach, they just look for external excuses or rely on luck again. So it blocks that crucial self reflection. What they need to do is really break down each trade, see where bias crept in, and use those lessons to refine their strategy.
So why do trader feel invisible during winning streak?
Yeah, that's really common. When traders are on a winning streak, they often feel like the market is in sync with them, so they believe their skill is driving it, not just luck. This invisible feeling of invincibility lets them take bigger risks, thinking they're unbeatable. And that's when the market surprises them, because that confidence blinds them to the normal risks they were ignoring.
How does emotional attack to trading risks?
Yeah, so
Trading increase risk.
exactly. When traders get emotionally attached to a stock, a position, or even a certain strategy, they stop seeing the trade objectively. They take on more risk than they should, they stay in losing trades too long, and they let fear or hope override their logic. So that emotional attachment distorts their risk perception, and that's what leads to big preventable losses.
How does our confidence lead to a large drawdowns?
So, overconfidence leads to large drawdowns because traders take on bigger risks than their plan allows. They believe they'll keep winning, so they keep adding to losing trades or avoid cutting losses. As a result, those small setbacks snowball, and the drawdown turns into a major account decline. In short, that misplaced confidence keeps them from taking appropriate protective steps, and that's what amplifies the loss.
So why does exist leverage result of base overconfidence?
Yeah, exactly. Leverage is such a classic amplifier of overconfidence. When traders feel invincible, they borrow more money to boost their position sizes, thinking it'll just multiply their returns. But of course, it magnifies losses just as fast. So their overconfidence blinds them to the risk, and a small downturn can wipe out a huge portion of their capital.
And so how does overconfidence trade estimate their
Yeah, Of course, overconfidence often leads traders to underestimate how much risk they're taking. They might ignore or downplay potential losses, or they assume their future outcomes will mirror their past wins. As a result, they set targets too high, take on more exposure than they can handle, and ultimately suffer bigger drawdowns. So that
Well,
failure to accurately.
everyone, thanks for watching. If you want, still hit like and subscribe. Bye bye.
You're welcome. And